Income Tax 2020. Tax Software Example, Schedule C, Inventories. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along, but I do think they have a 30-day free trial, so if you can get access to a promo version of it, it might be a good tool to practice with. We're going to be focusing in on the Form 1040 related Schedule C and specifically on inventory and its effect on the accounting method like a cash accrual or other method, and the calculation of the cost of goods sold that could be necessary if you have inventory. We're going to be going back and forth from the detail to the forms as we make different adjustments or alternatives and scenarios, the software making it easier for us to do so. Starting scenario will be single tax filer, Eric Smith, living in Beverly Hills 90210. We're going to be starting out with a Schedule C business. So the Schedule C business is here. It's flowing into the first page of the 1040 as 100,000 on line 8. We have half of the self-employment tax being deducted here as an above-the-line deduction, getting us to the total adjusted gross income. We then have the $12,400, which is the standard deduction, qualified business income deduction 16104, and then the taxable income of the 64,428. Our focus here is going to be on the Schedule C and the cost of goods sold calculation. As of now here on the Schedule C, we have a cash method selected, and if we scroll down, we have a basic income statement here, just the $125,000 in the income. Nothing's in the cost of goods sold line item. We're imagining here that we do not have inventory, and then down below we have one expense down here to get us to that $100,000, which is in essence kind of like the net income that flowed forward to the first page of the 1040, or it flowed forward, in other words, to the Schedule 1, Part 1, and then to the first page of the 1040. Now, if you're a small business and you do not have inventory, it's quite common for people to basically be choosing the cash method. That's going to be quite common for small businesses with no inventory. If they have inventory, then oftentimes they're going to be needing an accrual method. Remember that this choice as to whether you have a cash method or accrual method will typically be made when you first start the business, the first time you're reporting the Schedule C. So if you're looking at the prior tax return and they had a Schedule C last year, it's the same Schedule C this year, then the accounting method will most likely already be chosen, and you're going to basically be following along what happened in the prior year. If it's the first year, then you need to make that determination, and you want to think about it a bit. If they have inventory, then you want to make sure you're picking the right accounting method, because there is a consistency principle. The IRS doesn't want you or doesn't permit the accounting method to be changed back and forth, because that can alter the amount of income that would be reported from year to year. So once you choose a method, you're kind of locked into it to some degree. You might be able to change it for certain circumstances, but you'd have to request it typically from the IRS to do so, to allow you to basically do so. So let's imagine that we have now inventory. So if we have inventory, I'm going to go back on over into the data input for the Schedule C. The Schedule C then we'd be, of course, choosing possibly or more likely an accrual method. I'm going to do that by just going here and say it's going to be accrual. Now, it could be something, you could choose like a hybrid type of method and say some kind of hybrid method, but the IRS may force you, if you have inventory, substantial amount of inventory, to at least be tracking the inventory and the purchases on basically, an accrual method, because that's what's going to basically be happening on the books, and that if you didn't do that, it would distort the books. So that would push it over here to the accrual method. Now, also, from a logistical standpoint, oftentimes when you're doing the tax data input, you possibly didn't do the bookkeeping. Someone else did the bookkeeping. They gave you financial statements, balance sheet, income statement, or possibly just an income statement, right, that you're putting into the tax software. And they might then have the cost of goods sold already populated here as one number. And the problem there is that then you need to go to the page 2 and do this cost of goods sold calculation in part 3, which is basically a periodic calculation, a periodic inventory method type of calculation. So if that happens, then how do I go back in and do the cost of goods sold calculation is often kind of the question. So we'll do this fairly quickly just to get an idea of what could happen. If you got an income statement, the cost of goods sold is on the income statement. You're going to say, all right, well, the cost of goods sold, if I go over to my data input, I'm going to say, well, the cost, I don't know the beginning inventory possibly, and all I know is what the cost of goods sold they gave me is. So I'm just going to put it into the purchases item at this point in time. I'm just going to say the cost of goods sold is 20, let's say it's 20,000. Cost of goods sold 20,000. If I go back into the forms, now it's showing at 20,000. So if that is what is on the income statement, then my net income would be correct, but I wouldn't have the supporting part for Schedule 2. I just have everything in purchases. Now, it also might be the case that, and this is where I would basically start. I would start that way so that I can do the data input and get to the bottom line net income and understand where that number comes from before I start manipulating the cost of goods sold calculation and put it in the beginning and ending inventory. So also note that you might already have the beginning inventory in there because it was carried forward from the prior year. So let's say the beginning inventory was already populated here from a carry forward from the prior year at 10,000. Well, now if I try to just put in the correct number, which is 20,000 on the income statement, then it's going to be off here. I want to make this number 20,000 and then go back to it and worry about possibly the calculation in more detail. I might put a check on it and say, okay, first I want to get this bottom line number correct, so I'm going to force this number to match what would be on the income statement provided to me, even though I don't have the whole cost of goods sold calculation, right? So I'd go, okay, let's make this then 20,000 and then minus the 10,000. So then I would just do what I got to do in order to make this the 20,000 there. So now I got the 20,000 there. Then I can check that my ending inventory is correct, that my net income is correct, and then I can go back and see what I can do to populate the rest of this out. Now if you're looking at your cost of goods sold formula here and you're trying to say, okay, I know what the bottom line is. I know the bottom line is 20,000, but I don't know really the rest of it. Well, again, you might know the beginning inventory. The beginning inventory should be the same as it was on the last year's cost of goods sold calculation. In other words, last year's cost of goods sold calculation will have ending inventory on line 41, or might not be the same line probably, but it'll have ending inventory. That ending inventory at the end of last year should be the beginning inventory at the beginning of this year. So this number is going to be something that's going to be a given. If they had cost of goods sold calculation last year, you could just look at the return and see what was there last time and say, okay, that was 10,000, and then you know the bottom line should be 20,000, and the difference could be, purchases, if the only difference is purchases. Again, they might have other things. If they make their inventory, then it might be more complex. But just note that if you have this information, you can kind of back into this. You say, well, beginning inventory, this is a standard cost of goods sold calculation. Beginning inventory was 10,000. Purchases, I don't know, so I'll make that yellow. This is the unknown, and then I know that this should be the sum. This would be how much would be available for sale throughout the entire year on like a periodic method. And the ending inventory is also something that we don't have. We may not know the ending inventory. Now, if we have the balance sheet, we should know it because it'll be on the balance sheet. But if all we have is the income statement, then we may not know the ending inventory here as well. The cost of goods sold, we do know what that is. The cost of goods sold is going to be the 20,000 because that's on the income statement. So if they gave me the income statement, I wouldn't know beginning inventory from the income statement, but I know it from the prior year tax return. I wouldn't know purchases from the income statement or prior year tax return. And then I wouldn't know ending inventory from the income statement. So of these, the easiest information to get from the client if we don't have it yet would be the ending inventory because that would be on the balance sheet. So if they give us the ending inventory on the balance sheet, and let's say the ending inventory is 3,000 on the balance sheet, then we can back in then to the purchases. The purchases, possibly we can ask for the purchases, but again, you can kind of think about, well, maybe I can back into the purchases if you have everything else, basically, and then that would be the easiest way to kind of back into your formula. So to do that, you can obviously write this in an algebraic equation and then solve for the unknown. You can use GoalSeek in Excel, so I'll practice just doing that, just to practice the tool of GoalSeek. So let's do a formula here. I know that this should be 20,000, but let's go ahead and say, well, I need it to be equal to that 10,000 minus the 3,000, and then this should be 20,000. So notice this is a formula, this is a formula. Now I'm going to use GoalSeek. So I'm going to say I know what this is now. So this is not an unknown anymore. I'm not going to make it white, but blank. And then I'll put an underline here. The unknown is going to be this item. So I want to change this so that this 7,000 will then be 20,000. I'm going to use goal seek to do that. So to do that, I'm going to go to the data information. I'm going to go to forecasts, what if, and I'm going to use goal seek. And now I'm going to basically say I'm going to use trial and error with goal seek. So I'm going to say I want you to change this cell. So set that cell to be, I'm going to hard code this 20,000. And I'd like you to do that by changing this cell. So I want you to change that cell. So we're going to say once again, this cell down here, that 7,000, because it's connected with a formula, I'd like you to just use trial and error to make this cell whatever it needs to be to make that cell 20,000. And it'll just use trial and error to do that. So I'm going to say, okay. So, and it's just a useful tool to know that goal seek. So then we got the 13,000, right? And if I was to copy this over and just copy the formula and do the math on it, just to check it out, to double check it twice with a double check. This would be this plus this. This would be the 3,000. And then we have this would be this minus this is of course the 20,000. And that can help you to kind of populate, or how to think about how you'd populate this item, because again, oftentimes you only have the income statement for a basic Schedule C that you can kind of back into these numbers. So then I can go in to this one and say, all right, this needs to be 10,000 and then 13,000. So I'm going to say 13,000. And then we had ending inventory, which was 3,000. On the ending inventory, 3,000. And then if I go back on over, we should be back to that 20,000. And then if I go back to the first page, then we have the same 20,000 there. So again, the problem you often have is you got the income statement, you got the 20,000, but you don't have the cost of goods sold formula. When that's the case, you might want to write out the formula here and then see if you could back into one of the numbers. Possibly you might need to do that in some cases, or you can ask for the more detailed information from the client. But if you just have the balance sheet, then you may be able to kind of back into the purchases. Now, obviously, if the cost of goods sold is like something that you're producing or making, like you have a manufacturing company as opposed to just a purchase and sale like a retail store, then you might have a more complicated situation here, having materials and other costs that could be related in the cost of goods sold calculation. But if it's just basically purchase inventory and selling inventory, then you might be able to back into basically the purchases item, and that could be a common kind of situation when you're doing basic income statement returns for basic inventory amounts.